So I kind of walked through the different definitions of a Ponzi scheme, and for example, the SEC has a good list of what defines a Ponzi scheme or what some of the red flags are looked for. And the reason I did that is because one of the common criticisms of Bitcoin is that it's a Ponzi scheme, that it only you have to keep people have to keep buying into it in order for it to do well, which of course has some degree of truth to it. So I went through it and kind of looked at it point by point. And you can kind of break that into a narrow definition of a Ponzi scheme, like an outright fraud, versus a broader definition of it. And so from the narrow scope, one of the things I looked at was kind of the whole launch process of Bitcoin. And so what we saw, for example, was that the creator or creators, we don't really know if it was a person or a group, but Satoshi Nakamoto, it was interesting because they released a white paper pretty much showing how to do it before they launched it themselves. And so rather than kind of keep all their secrets to themselves and then launch it, they released the white paper. They got criticism on it. They kind of had some interaction with other experts in the field, almost like a thesis defense in a way. And then they went ahead and launched the software, and then they gave themselves no pre-mine, so they didn't give themselves coins and then launch it. They had to continue to mine it just like anyone else on the network, so they had really no inherent advantage, and that kind of contrasts to a lot of the ways that later tokens launch themselves. A lot of them use pre-mines, to their founders and their initial investors, whereas Bitcoin was launched more like a protocol rather than more like an investment. And so,
right.
By most metrics, the narrow definition doesn't really apply. And then the broader sense is just the idea that, really any non-cash flow producing asset is only worth what you think someone else is going to pay you for it in the future. And that's true for Bitcoin, that's true for gold, that's true for, fine art, beachfront property that you don't plan to rent out. All these kind of high-end kind of scarce goods, they're always based on, their scarcity and their desirability. And so it kind of goes through and just compares Bitcoin to some of those other things. And one thing that they all have in common is that they have some degree of utility, right? So, fine art has utility, a classic car has utility, beachfront property has utility, gold has utility, but they also all have a monetary premium associated with them. And so they're bought for, more than just their utility. And Bitcoin's kind of a similar way, because for its utility, you have, permissionless international payments that pretty much can't be stopped, and easy mobility of funds, right? So you can just remember a 12-word seed phrase and go anywhere in the world, across borders, and basically transfer wealth wherever you want. That's its utility, and then it has that monetary premium due to its scarcity. And so the overall point of the article is that Bitcoin still has a variety of risks. It's going through an adoption period, and we'll see how far it gets. But it doesn't really meet the definition of a Ponzi scheme more so than any other kind of non-cash flow producing monetary asset.
Bitcoin tomorrow, let's say all the hodlers of Bitcoin decide that it should be worth $20, and so they push the price down to $20 a coin. I think that's the risk that investors are considering, that this group mentality, this herd mentality of irrationality could just all of a sudden push prices in either direction. Well, could you see that happening?
Well, Bitcoin is certainly one of the more volatile assets out there. And so that's really true for any kind of monetary asset. And so we've built up fine art prices to very high levels. And we could see, next year that a lot fewer people want to buy that fine art. And suddenly, they all kind of, millions of them come to the realization that they should pay a third as much. And so, that's one thing to monitor. Same thing, there are $40 million beachfront homes, throughout Florida, and you could find out that, maybe, next year they all want to pay $10 million for those, and it's, it's certainly possible, but there are a lot of on-chain indicators you can use. And so, for example, we can see what long-term holders are doing with Bitcoin, and we see that as the price goes up much, much higher, they're slowly willing to sell, some of their tokens, because they've gone up 5x or 10x in some cases. But you don't see a lot of kind of movement from those long-term holders. A lot of those intermediate term, kind of like the near-term kind of price volatility, a lot of that has to do with the trading activity that we see on exchanges, whereas the long-term holding is actually kind of a steady thing to watch, similar to accumulating other types of property.
Would you consider investing in any of the other altcoins that maybe have smaller market caps but also upside potential?
So personally, no, but I can see why people do it, because during the bull runs, a lot of those alt tokens tend to, even outperform Bitcoin in many cases in terms of percent gains. The problem that you run into is on the down leg of the cycle, Bitcoin's volatile enough, but some of those altcoins fall even farther. And then unlike Bitcoin, that it goes through this 4-year halving cycle, keeps making new highs every cycle. A lot of those other altcoins, after they have their blow off top, they never recover in later cycles. And so really the two big ones are Bitcoin and Ethereum. But as you start venturing down to some of those other tokens, that gets increasingly risky, and people should be aware of the risk they're taking on if they want to go outside of Bitcoin, essentially.